Updates, Karabo. Now checking in on how the markets are performing. South Africa's benchmark index appears poised to close the session and the last trading day of the month, in fact, in the red, with resources currently leading the losses at a decline of near 1%. But I will say it has been a positive week for the all-share, firing on all cylinders and reaching levels never been seen before at over 95,000 index points, although I will say that we have slightly cut back from those levels right now. This was after the local central bank trimmed interest rates by 25 basis points as markets had widely expected. On the global front, stocks have slumped to close out a big winning month, and this is after President Donald Trump said China has violated its preliminary trade agreement, igniting fears that the U.S. could enter a drawn-out trade war. But joining me now for your mix of local and global market news is Keiran Witthuhn, portfolio manager over at Robert Cohen Investments. Keiran, thank you so much for coming into studio.
Thanks for having me,
so, I mean, tariff uncertainty and confusion is back now, and 1 minute tariffs are back on, the next thing they are off. But just looking back, perhaps at the trading month that was for the month of May, there has been fears of U.S. recession. We saw Moody's cutting down on the U.S. debt rating there, and also they were there are mounting fears of a fiscal deficit. So looking at where we are right now and the issues with investors having to contend with a lot of, when it comes to the U.S. macroeconomically, where are we? What's next? What are you looking at?
Yeah. So I think, to be honest, in the context of this year, May was almost a bit of a quieter month. I almost want to say on the news flow after the complete carnage that was March and especially April, that just saw a month of two halves. But there are still certain narratives in the market, many of them macro-driven. So obviously the US rates market has shown us that investors are concerned about deficits. And the tariff threat is still lingering. But yeah, as you say, one day it's on, one day it's off. And I think investors are actually, to be honest, getting a bit numb to it. It's in the headlines every day. And I think looking past it now to a certain extent, companies have shown that they can innovate and sort of compromise around the regulations in place. But now we see, of course, I don't think the Trump administration is going to back down. But then also we've seen the structural trend of artificial intelligence, which I think is starting to come back to the forefront. We saw that with NVIDIA's results, and that has helped US tech lead global markets higher in the past month.
We'll come back to the AI darling that is NVIDIA and Alphabet. But just like circling back to the U.S. economy and the financial markets, looking at the U.S. dollar, it has been the best week for it, but this does not reverse the declines that we saw. Is this something that you're looking at? Because I saw some comments, some market watchers saying that perhaps this is time for the euro to take the spotlight.
Yeah, so I think in the longer term, the dollar has been overvalued. But I think in the short term, it's now undervalued. That's sort of the approach that we've taken. And I think as well, every few years, this narrative of the death of the dollar does come up. And obviously, there's deficit concerns now. There's the institutional credibility being called into disrepute in the US. But we think, again, that it's a bit overhyped, largely sensationalist. And so yeah, the dollar, I think, could still weaken further towards that 120 to the euro level, but we are not overly concerned in the long run quite yet. We just think it's sort of been a sell everything US market, and the US dollar has got caught up in that. And, you know, this is what happens to financial markets. There's narratives that tend to lead things too far one way, then too far the other way. But, of course, this can change with policy, but at the moment, we are still pretty content with most of our holdings in US dollars.
Speaking of holdings, I saw a report earlier this day from Bank of America saying that investors have withdrawn $9.5 billion from global equities during the week, the biggest outflow, in fact, in 2025. So how are you changing your offshore portfolio?
So we have not done a whole lot in the last month. We've tried to not let the noise around tariffs and policy making force us into decisions that we were not that we thought were not the best long-term decisions to make. So we were adding in April and the early parts of May, but markets have run quite hard again. And there's less margin for error now than there was a month or two ago. So we are now, again, getting quite cautious. The US market in particular is not cheap. we do favor, as I've said on the show quite a few times, we do favor the US market still. We think that's where we're going to gain the benefits of the structural trends of technology. But a more cautious note than we were a month ago, but certainly not following the global trend of selling out of the US.
Okay. And what about the US PCE inflation numbers that came in lower than expected at 2.1%? Does it change anything fundamentally when it comes to the Fed's monetary policy stance and trajectory?
Yeah, so obviously it's the Fed's preferred inflation reporting measure. And yeah, I think it was quite interesting because it showed that that consumers and businesses were pulling forward quite a lot of consumption up to the end of March. And then in April, we saw quite a big drop in imports, quite a big drop in spending. But at the same time, the data also showed that the US consumer does remain resilient, but not as resilient as before. And we think that there's possibly 2 more Fed rate cuts going into probably the middle half of the year. But it's quite tough to forecast out further than that. We think inflation's on a downward trajectory, but there is upside risk to inflation, obviously, with tariffs. But oil prices are coming down. So we think actually the inflation picture is looking quite good in the US, and I think that's also why the stock market's run a bit in the past month.
And post the 90-day tariff pause, do you still expect inflation risk to be to the upside?
So I think it all depends on the tariff approach. There's 2 arguments at the moment. The one is that the Trump administration is using this as a revenue gathering tool. And if that is the case, then because obviously they're pushing through the tax bill and now they need to raise revenue, which they'll probably do through tariffs. That will not be good for inflation because they could be more hawkish on tariffs. But the other school of thought is they could be using this just for leverage. We know he likes to go in all guns blazing and then kind of pull back. So it really is tough to say. We have been more on the optimistic side of things. We think that he's going in aggressive and then will likely pull back. We think the market is catching on to that now as well. But so inflation, I think, unless something changes in the policy making, we do think inflation will not spike as many did fear a month ago.
Now, Trump has accused China of violating its preliminary trade deal with the US, and he even went as far as to say that, you know, this is what he gets for being such a nice guy. How are the markets interpreting relations between the US and China? I mean, how long is this war going to go on for?
So I think we definitely are only seeing the start of it. I think they will become more amicable towards each other. They realize that they're going to have to work together to a certain extent. But of course, it's a very complex relationship. And as we've seen, things are going to change each day. Tomorrow, there could be good news. But interesting with the NVIDIA results is really that they want to sell chips to China, obviously. And the Trump administration has told them, you will not sell chips to China. So that's, I mean, there is a broader technology race going on here, and neither country wants to lose that. But I think regarding goods trade and trade involving not the technology side of things, I think they'll largely work it out. But I think that's why China down today, resources down today, South Africa down today, obviously on that news.
And now let's talk about this big AI mistrust. What is it and how does it play out into the revenue estimates and guidelines that the companies AI, Alphabet and NVIDIA have given?
So there's been the DOJ has been after big tech for quite a while now. And Alphabet's at the front of who they're trying to get. There's also Meta, there's Apple, and Alphabet is the one that they're really after now. And there's obviously there's a balancing act because you don't want a monopoly in industries, but also you don't want to stifle innovation. So there's a fine line there where if they do pass these antitrust laws now and they they want to break up advertising and search in Google away from the main Google business and list Chrome separately, that could stifle innovation and disincentivize innovation amongst those big tech companies in the US. It could be the first one to go, and then after that there could be quite a few tech companies that the DOJ will be after. We actually think, though, which is why we've sold down recently on Alphabet a bit, but ironically enough, we think that if Alphabet does get broken up, the sum of the parts valuation will be higher than its current valuation. So if you separate its 3 main businesses, I think as shareholders, you'll actually you'll benefit from that.
But don't you think in the case of Alphabet that they are so used to making big bets for the long run? And I'm looking at the company's data historically. It has been working for them, isn't it?
Yes, it has been. So obviously the search is backward looking, but now the DOJ is concerned about what AI is going to do, and they think that if you've got a slight monopoly now, when things exist now, when AI fully is affecting every industry, I think that's what the concern is that Alphabet, companies like Alphabet are just going to have large amounts of data at their disposal, and it has lagged on the share price. We've seen Alphabet's rating is far below that of a company like Microsoft. So the market is aware of this. Yeah.
Okay. And Keiran, what would you say are the biggest risks to your outlook right now?
In terms of macro or okay.
Both.
So I think if the earnings growth in the US does not come through as we expect, we are very bullish on the AI trend. Okay. And we still think that's going to keep on driving earnings. We just came off the back of a very positive earnings season where we saw many of those companies beat. So I think as long as earnings growth is still accelerating in the US amongst the companies we have big positions in, I think we'll largely look past the politics.
Yeah. Okay, coming back home, looking at the JSE, we did reach a new intraday record again today. We have been firing on all cylinders, but we have slightly come back from those levels. What do you think is on investors' sentiment or minds right now as it pertains to local equities?
So I think local equities like US equities and offshore equities have become a bit stretched, the valuations. Things have run quite hard this year. And Palesa, actually, I looked at a chart of the S&P versus the JSE All-Share Index in the last about 3.5 years. In dollar terms, the JSE has outperformed the S&P. So the South African markets have been really strong. Still cheap, but they have been strong, and I think investors are less convicted than they were. There hasn't been much change on the ground, as we would know. So we are still quite positive on South Africa, but being a lot more selective in where we are allocating. And obviously the resources has been a big reason why South Africa's run so hard this year. Yeah.
And going into the month of June, do you still think there's still more steam to run?
It's tough to say, but we are not allocating new money to the market now. So I guess that would probably lead me to say no. Things have run quite hard. So let's see how the middle of the year goes, both offshore and locally.
Okay. Now, finally, before I let you go, yesterday we had this the SARB MPC. They cut interest rate by 25 basis points, which was widely expected. But how many cuts are you pricing in then from the SARB this year?
So we've got the same prediction as offshore. We've got two more 25 basis points cuts priced in. And we think ultimately the main takeaway from yesterday is that the SARB is really lining up to cut the inflation targets to 3%. I think that's widely expected by the market now. I think a lot of people don't agree with that. Obviously, we're a different economy to many advanced economies of lots of supply side issues, but that is what I think the SARB is really gearing up for, is a lower inflation target.
And do you see this as something as that might lift the bond market, South Africa's bond market?
I think it will lift the bond market. It will strengthen the rand, but that's why I think the rand has also been quite strong this year. One of the many reasons, but that is a reason, is because people are thinking that rates in the medium term could be a bit higher if the inflation target does move down.
Okay, Keiran, we'll leave it there for now. Thank you so much for joining us in studio. And that was Keiran Witthuhn, who is portfolio manager over at Robert Cohen Investments. We are headed into another short break. We'll be back with you shortly after this.